Welcome back to the Deep Dive. It is Tuesday, January 27th, 2026. Today, we are looking at a story that, I think, requires us to put aside some pretty deeply ingrained preconceived notions.
Oh, for sure.
If you follow the healthcare markets, or honestly, if you just follow the wild world of retail trading and, meme stocks over the last 5 years, you absolutely have an opinion on the company we're discussing today.
Oh, everyone has an opinion on Clover Health, usually a very strong one, and rarely a neutral one.
Exactly. For the longest time, Clover was the ultimate battleground stock. You had the short sellers on one side calling it, a broken business model, a cash incinerator, a SaaS disaster.
All of the above.
And then you had the retail faithful on the other side insisting it was the Tesla of healthcare, the future of medicine. But while the market was arguing and the stock price was, bouncing around, the company was quietly, systematically re-engineering itself.
They were just heads down doing the work.
And about 2 weeks ago, on January 14th, they dropped a number that frankly silenced a lot of that noise.
It didn't just silence the noise, it fundamentally changed the math. I mean, it forced everyone to pull out their spreadsheets and rerun the models.
We're talking about membership growth.
Yeah.
They announced 53% year-over-year growth for the 2026 plan year.
53%.
They hit approximately 153,000 members.
And to put that into perspective for everyone listening, the guidance, the number Wall Street had priced in, the number the analysts were expecting, was around 33%.
Right.
So a 20-point beat on enrollment is not a rounding error. I mean, that is a massive deviation from expectations. It's a blowout.
And it's even stranger and perhaps more impressive when you look at the rest of the industry right now. We are currently in what I would call a sluggish era for Medicare Advantage. The gold rush days seem to be over for the big guys.
Sluggish is polite. It's defensive. If you look at the giants, United Health, Humana, CVS, Aetna, they are pulling back.
Oh, yeah.
They're exiting counties, they're shedding unprofitable members, and they're tightening their networks to control costs. The industry average growth is maybe 2% or 3%?
2 or 3%, yeah.
So you have the titans of the industry growing at 2%, retrenching, licking their wounds from 2025, and this InsurTech challenger is growing at 53%.
It just doesn't compute. It suggests a massive disconnect. Either Clover is making a colossal mistake by picking up the customers everyone else is dumping.
Right, the ones nobody else wants.
Or they have figured out a way to make those customers profitable that the big guys haven't.
And that is the core tension of this entire story. That's the whole ball game right there. And that's why today is so important. Management has flagged 2026 as the inflection point.
A big year.
They have committed to full-year GAAP net income profitability.
And we need to pause on that phrase, GAAP net income. Because in the tech world, and definitely in the SPAC world, companies love to use creative accounting. They love adjusted EBITDA.
Oh, contribution profit.
They love to strip out stock-based compensation, interest, taxes, depreciation, and essentially anything that costs money to make the number look positive.
Right. We've seen community-adjusted EBITDA and all sorts of creative metrics in the past. It's almost a joke. But Clover is saying, no, GAAP. Generally accepted accounting principles.
The real bottom line.
The number that actually matters for long-term viability, the one you can't really hide from.
So, our mission today is to tear this apart. We aren't looking at the stock chart. We're looking at the mechanics of this machine. How does a company that historically lost money on every new life suddenly flip the switch to profitability while adding 50,000 new people?
It's a huge question.
We need to understand if this is a sustainable model finally proving itself, or if this is, a high-wire act that is one gust of wind away from disaster.
And to do that, we have to talk about the J-curve.
The J-curve. This is the economic concept that explains the whole thesis, right?
It is. It's everything. If you don't understand the J-curve, Clover looks like a cash incinerator. If you do understand it, it looks like a coiled spring. It's the difference between seeing a disaster and seeing an investment.
Okay, so here's the roadmap for the next hour. We're going to start with their quadrillion business model, why they're zigging while the industry zags.
And they really are zigging.
Then we're going to do a deep forensic audit of that J-curve math. We'll look at the engine, the AI technology, and ask if it actually works clinically.
The so what factor.
Exactly. And finally, we have to look at the bear case. Because even with this growth, there is a massive cliff looming in 2027 that nobody should ignore.
There's always a cliff in healthcare. It's never a straight road.
Always. Let's jump into section 1, the contrarian business model. I want to start with a bit of an identity crisis. Or maybe it's just branding. But Clover refuses to call itself an insurance company.
They are adamant about this. I mean, if you listen to CEO Andrew Toy or read their 10Ks or look at their investor decks, they define themselves as a physician enablement technology company.
Which, to a cynical ear, sounds like marketing fluff.
It does.
It sounds like something you say to get a tech valuation multiple of 10x revenue instead of an insurance multiple of, 0.5x revenue.
Right. And look, I'm sure that serves that purpose, and that's part of the calculation. But in Clover's case, I think it's actually a description of their operational DNA. It dictates how they spend money and how they structure the business. They view the insurance plan, the actual PPO that seniors sign up for, as just a go-to-market strategy.
Okay, let's unpack that for a second. Insurance as a go-to-market strategy. That's a heavy concept. What does that mean in practice?
Well, think about how you get software onto a doctor's desk. It is incredibly hard.
Impossible, almost.
Doctors are overwhelmed. They hate new software. They hate learning new systems. Their EHRs are already clunky. If you just knock on their door and say, hey, buy my AI diagnostic tool, it's $500 a month, they will slam the door. They don't have the budget or the patience.
Right. The sales cycle for medical software is notoriously brutal. It can take years.
Exactly. But if you say, hey, I'm an insurer, I'm going to pay you for your services, I'm going to bring you patients, and by the way, here's a free tool that helps you get paid faster, manages your patients better, and handles your administrative burden, suddenly you're in the room.
So the insurance plan is the Trojan horse.
It's the Trojan horse to get the technology adopted. That's the perfect analogy.
That is a fundamental inversion of the incumbent model. Because for United Health or Humana, insurance is the product. Risk management is the skill.
Correct. The incumbents are actuarial firms at their core. Their superpower is predicting risk and pricing premiums. They hire armies of actuaries to figure out exactly how sick you are likely to be, and then they price the plan accordingly.
They're managing a spreadsheet, basically.
They're managing a spreadsheet of risk. Clover is betting that their superpower is software that alters risk. They aren't just trying to predict the cost, they're trying to bend the cost curve down.
And this philosophical difference isn't just academic. It shows up in the actual product design, specifically regarding networks. We mentioned earlier that the big guys are retrenching. What does that look like on the ground for a senior?
It looks like fewer choices. To control costs, the traditional playbook is the HMO, the Health Maintenance Organization.
The gatekeeper model.
Exactly. You lock the patient into a narrow network, you have a gatekeeper primary care physician. If you want to see a specialist, you need a referral. If you want to go to the best cancer center, but it's out of network, too bad. You are financially penalized or simply denied coverage.
It's restrictive. It's all about control.
It's highly restrictive. But it works financially because if you funnel all your volume to a small group of doctors, you can squeeze them on price. You go to a hospital system and say, I'll give you all my patients, but you have to accept 80% of Medicare rates. It's a volume for discount trade.
So that's the industry trend. Narrowing, restricting, squeezing. Clover's doing the opposite.
180 degrees opposite. They are doubling down on PPO-preferred provider organization plans.
Doubling down is an understatement.
As of January 2026, roughly 97% of their membership is in wide network PPO plans.
97%. That is just, it's a staggering number in this environment. A BPO basically means you can see anyone who accepts Medicare, right?
Essentially, yes. If the doctor accepts original Medicare, Clover pays them. No referrals needed, no gatekeepers. You wake up with back pain, you can go straight to an orthopedist. You don't need permission.
So why is this considered contrarian? I mean, why doesn't everyone do this? If customers love choice, why are the other insurers running away from PPOs?
Because PPOs are terrifying to underwrite. In an HMO, you control the patient journey. In a PPO, the patient controls themselves. They can go to the most expensive specialist in town. They can get second opinions.
They can run up the bill.
They can utilize care in ways that are very hard to predict. It is historically very hard to control the medical cost ratio, or MCR, in a PPO because you don't have those administrative gatekeepers blocking access to care.
But this explains the 53% growth.
It explains it perfectly. I mean, just imagine you're a senior living in New Jersey or Georgia. Your friend just got a letter from Humana saying your doctor of 20 years is no longer in network.
That's terrifying for them.
You're scared, you trust Dr. Smith, you feel displaced, and then you see a Clover ad on TV saying, keep your doctor, see anyone, we don't care.
It's a magnet for what the industry calls displaced seniors.
Exactly. While the incumbents are forcing seniors to change their behavior to save money, Clover is saying, don't change your behavior, we'll change the back end. They are scooping up the people who value choice above all else.
But, and this is the billion-dollar but, how do you afford that? If the only way to save money traditionally is to restrict access, and Clover isn't restricting access, aren't they just setting themselves up to go broke? I mean, are they just being reckless?
And that brings us right back to the physician enablement thesis. Traditional insurers manage cost by restricting access.
Right, the HMO model.
Clover manages cost by improving decisions. They believe that if they use the Clover Assistant to help the doctor make better clinical choices, catch the disease earlier, prescribe the right meds sooner, manage the chronic condition better, they can lower the total cost of care without needing to lock the patient in a cage.
So the bet is, we don't need a narrow network of super doctors. We can take a regular network of average doctors, layer our AI on top, and turn them into high-performing doctors.
That is the thesis in a sentence. Technology replaces the HMO gatekeeper. The software acts as the virtual gatekeeper, not by denying care, but by guiding care.
Which sounds great on a slide deck. It sounds utopian, but we need to see if the math actually works.
Yeah.
This segues perfectly into Section 2, the J-curve economics. You said earlier that if we don't grasp this, we don't understand the company.
Right. So let's get granular. We need to be actuaries for a few minutes here. The J-curve describes the profitability of a Clover member over time. In most businesses, like selling shoes or coffee, you sell a widget, you make a profit immediately. In Medicare Advantage, specifically Clover's model, a new customer is a liability.
A liability, okay. So we have data on this from their recent investor presentations. They break it down into new members versus returning members. Let's look at the new member profile.
Okay, so these are the people Clover aggressively acquired in 2025 and is acquiring now in 2026. The data shows that a new member generates a contribution loss of approximately $110 per member per month.
Stop there. I want to make sure I hear that right, and everyone listening hears that. Every single month, for every single new person they sign up, they are losing $110.
Correct.
That's over $1,300 a year per person in losses.
Correct. It's a cash drain, a
Yeah.
planned one, but a drain nonetheless.
Why? Is it just marketing costs? Is it just the cost of the TV ads and paying brokers?
Marketing is part of it. Broker commissions are expensive, acquisition costs are high, but the bigger factor is unmanaged utilization. When a senior switches to Clover, they often come with, let's call it baggage.
Okay.
Maybe they have an undiagnosed heart condition. Maybe they're on 5 different medications that interact poorly. They haven't seen a doctor in 6 months. They are a walking utilization risk.
And crucially, the Clover Assistant hasn't had time to work yet.
Exactly. The AI is blind because it has no data on them yet. It hasn't ingested their history from all those different sources.
Yeah.
So in year 1, Clover is paying the claims, paying the brokers, and scrambling to get the patient to a doctor to collect data. That costs money. That is the bottom of the J.
So you acquire a customer, and for the first 12 months, you are basically bleeding cash on them.
Yeah.
But then they survive year 1, they renew for year 2. What happens then?
The economics flip.
Completely.
Returning members, so those in their second year or beyond, generate a contribution profit of approximately $217 PMPM.
That is a massive swing. From minus $110 to plus $217. That's a delta of over $320 per member per month.
It's huge. It's night and day. And that swing is driven by what they call the maturation multiplier. You can see this in the medical cost ratio, or MCR.
Which is just the percentage of premium they spend on care, right?
Exactly. The data indicates that MCR improves by about 700 basis points. That's 7% from year 1 to year 2.
A 7% margin improvement.
Yeah.
Just by keeping the customer. That's a big deal.
And it happens again.
Mm-hmm.
From year 2 to year 3, it improves another 700 basis points. So over roughly 24 months, you are looking at a 1,400 basis point improvement in efficiency, a 14% swing.
Why? What is magically happening in year 2 and year 3? Is the patient just suddenly healthier?
It's not magic. It's data aggregation and management. By year 2, the Clover Assistant has ingested the patient's history. It has nudged the doctor to put them on the right meds. It has closed the care gaps.
So the patient is now managed.
That's the word. A managed patient is significantly cheaper than an unmanaged one because you aren't paying for surprise emergency room visits and surprise surgeries. You're being proactive instead of reactive.
So if we apply this to the 2026 inflection point, it's basically a demographic shift within their own customer base. It's not some external factor.
Precisely. It's simple math, really. In 2025, Clover grew 35%. That meant a huge chunk of their total pool was new members in that loser bucket, losing $110 a month.
Right, dragging everything down.
It dragged down the 2025 earnings. It made the company look unprofitable on paper.
But those people didn't leave.
Right. They liked the plan. Now it's 2026. That massive group from 2025 just graduated. They moved from the new bucket to the returning bucket. They went from losing $110 to making $217.
Wow.
This mix shift, having a higher percentage of seasoned, profitable members versus new, expensive members, is the primary engine for this promised GAAP profitability.
It's fascinating because it forces you to look at growth counterintuitively. In a SaaS company or a retail store, growth is always good.
Yeah.
More sales equals more money.
Right.
Here, rapid growth actually hurts your P&L today.
Yes. Growth is an investment in future cash flow, but a drain on current cash flow. That's why the market punished them for so long. The market looked at the losses and assumed the business was broken. Clover kept saying, no, look at the cohorts. Wait for them to mature.
And 2026 is the year they mature.
That's the theory. But I want to play devil's advocate against my own point here.
Please do.
This whole model relies on retention. If you pay $1,300 to acquire a customer and suffer through the loss year, and then they quit before year 2, you just lit money on fire.
You never get the payback.
Never. The J curve becomes an L curve. You just go down and stay down.
So retention is everything. What are their numbers? Are they good?
They're strong. Historically, they hover around 95% retention. The PPO model helps here. People don't want to leave a plan that lets them see any doctor. But if that retention dips, even by a few points, the J curve breaks and the math falls apart.
Okay, so we have the business model, this contrarian PPO bit, and we have the financial model, the J curve. But both of those rely on the clinical model. You mentioned that the maturation happens because the patient gets better managed. That assumes the software, the Clover Assistant, actually does something.
Correct. If the software is just a glorified billing tool, or if the doctors ignore it, the costs won't go down, and the J-curve is just a nice-looking lie on a PowerPoint slide.
Okay, so let's move to Section 3, the engine. Clover Assistant. We hear AI in healthcare constantly.
Yeah.
Every startup claims to have it. What is distinct about this? Why is it actually working?
The distinction is point of care versus back office. Most AI in healthcare is back office. It helps process claims or it helps coders optimize billing. It's administrative.
About getting paid more efficiently.
Exactly. Clover Assistant, or CA, sits on the doctor's desktop during the visit. It is a clinical decision support system.
Describe the user experience. So I'm a doctor. I'm seeing Mrs. Jones. She's in the room with me. What happened?
Okay, so you open CA on your computer. It has already aggregated data from over 100 sources. We're talking electronic health records from hospitals she visited 3 years ago, pharmacy data from CVS, lab results from Quest, and claims history. All of it.
And for listeners not in healthcare, we cannot overstate what a mess that data usually is.
Oh, it's a disaster.
It is siloed. It is fragmented. It's a nightmare.
It's a complete disaster. Your cardiologist doesn't talk to your primary care doctor. The hospital record system doesn't talk to the pharmacy system, but CA pulls it all together. And then, this is the AI part. It doesn't just show you a 50-page PDF and say, good luck.
Right. Here's more work for you, doctor.
Exactly. It synthesizes it. It uses machine learning to find patterns a human might miss.
Give me an example of a pattern, a real-world case.
Okay. It might pop up a prompt on your screen saying, Mrs. Jones is here for a flu shot. But her lab results from 2023 show a steady decline in eGFR, and she hasn't been screened for chronic kidney disease. You should order a renal panel.
So it's a superscribe plus a diagnostic safety net. It's catching the things the human brain might miss in a 15-minute appointment.
That's the perfect way to describe it. And we have data on the so what factor. Does this actually change outcomes? Because alerts are annoying if they aren't useful.
Let's look at diabetes. This is a massive cost driver in the U.S. Huge.
The data shows Clover Assistant helps doctors diagnose diabetes approximately 3 years earlier than traditional methods.
3 years?
3 years?
That's a lifetime in metabolic disease. That's incredible.
It is. It's the difference between managing it with diet and metformin, which costs pennies a day, versus waiting until the patient crashes. Managing it with insulin, dealing with foot ulcers, or treating diabetic retinopathy. Diagnosing early is cheap. Diagnosing late is catastrophically expensive.
And you have similar data for chronic kidney disease, or CKD?
Yes. Diagnosed about 1.5 years earlier, that allows you to slow the progression before the patient needs dialysis.
And that's a huge cost.
Dialysis is a nightmare for the patient. It ruins your quality of life, and it costs Medicare roughly $90,000 a year per patient. Delaying that by 2 years saves $180,000. That pays for a lot of wide network access.
And what about hospitalizations? Because at the end of the day, that's the big ticket item.
Reduced by approximately 20% for conditions like heart failure. This is the holy grail. The most expensive thing in healthcare is a hospital bed. If CA keeps you out of the hospital, the PPO model works. You can afford to pay the doctors a bit more if you aren't paying the hospital.
It really seems like this validates the physician enablement idea. You aren't telling the doctor what to do, you're just giving them the information they were missing.
Right. And there is one more metric here that really validates the PPO strategy: quality scores. We know Clover has had battles with CMS over the administrative side of star readings.
Right, that's been a headline for a while.
But if you look strictly at clinical quality HUD scores,
How do they rank?
Clover's PPO ranked #1 nationally for 2 consecutive years on HUD scores.
Wait, say that again? #1 in the country.
#1 nationally.
A wide-open PPO plan has the best clinical quality scores in the nation.
It fundamentally challenges the industry dogma that narrow network equals better quality. The old assumption was that you had to lock patients into a system to keep them healthy. Clover is proving that better data equals better quality. You don't need to restrict the patient, you just need to inform the doctor.
Okay, so the machine works. Now let's look at the money again. We talked about the J-curve, which is the internal engine. But for 2026 specifically, there are some external wins in the sales, helping them hit this profit target. Section 4, the 2026 profitability bridge.
There are 3 main pillars here that investors need to know. First is the star rating bonus.
This is the bit technical, but it's essentially free money from the government, right?
In a way, yeah. Medicare awards star ratings based on performance. If you hit 4 stars or higher, the government pays you a bonus payment per member. Now, this gets confusing because of the time lag.
Right, there's always a lag.
Clover achieved a 4-star rating for the 2026 payment year.
So for all of 2026, for this whole year, they're getting paid extra for every single member.
Correct. The impact is roughly a 5% revenue boost per member. When you do the math across 153,000 members, that is a massive injection of pure margin.
What does that work out to in dollars?
It's estimated to be over $50 million, and that falls straight to the bottom line compared to if they were a 3.5-star plan.
$50 million. That's a huge cushion for profitability. What's the second pillar?
The Part D subsidy. 2025 was a brutal year for insurers because of the Inflation Reduction Act changes and the explosion of GLP-1 drugs, Ozempic, Wegovy, Mounjaro.
The weight loss drugs, yeah.
Drug costs just skyrocketed.
And insurers had to eat that cost. It crushed margins across the entire sector.
Yes. But for 2026, CMS, the Centers for Medicare and Medicaid Services, adjusted the formula. There is a 40% increase in the Part D direct subsidy.
So the government is picking up a larger share of the drug tab.
Exactly. It doesn't solve the problem entirely. These drugs are still incredibly expensive, but it mitigates the pain significantly compared to 2025. It levels the playing field for them.
And the third pillar is my favorite because it speaks to the scalability of the model. Operational leverage.
This is the tech part of tech-enabled. If you are a services company, to grow 50%, you generally need to hire 50% more people. You need more nurses, more claims processors, more managers.
Your costs scale with your revenue.
Right. If you're a software company, you don't. Clover's SG&A selling, general, and administrative expenses is dropping fast as a percentage of revenue. In Q3 2025, it was down to 14.3%. That's a 440 basis point improvement year over year.
Meaning they can add these 50,000 new members without adding 50,000 new salaries. The software scales.
The Clover Assistant doesn't need a salary. It doesn't need health benefits. Once you build the platform, adding the 153,000th member costs very little in terms of overhead compared to the first member. That leverage is finally showing up in the P&L.
So 2026 is a Goldilocks year. It's the perfect storm. You have the J-curve maturity, the star bonus, the subsidy help, and the operational leverage all hitting at once.
All converging.
It makes the profitability target look very, very credible.
It does. It creates a very clear path to black ink. But we have to talk about the pivot that goes beyond insurance. Section 5. Counterpart Health.
This is the wild card, the SaaS option, the lottery ticket, maybe.
Launched in 2024, Counterpart Health is Clover's attempt to pull an Amazon Web Services maneuver.
Okay, explain the analogy for those who don't follow tech history.
So Amazon built massive server infrastructure to run their bookstore. Then they had all this excess capacity and realized, hey, everyone else needs servers too. Let's rent ours out.
And AWS became more profitable than the entire retail business.
Exactly. So Clover built the assistant to manage their own risk, their own PPO members. Now they are realizing, hey, Cigna and Blue Cross have the same problem with independent doctors. Let's rent the assistant to them.
But why would a competitor buy it? Why would Blue Cross want to use Clover's tech? That feels counterintuitive.
Because of the unmanaged tail. Every big insurer has a long tail of independent doctors they can't control. They earn on value-based contracts, they drive up costs, they're a black box.
And the big guys can't get them to use their own clunky software.
Right. So Counterpart offers a solution. Deploy our tool. It saves your doctor's time with AI scribing and other features, so they'll actually use it. And it lowers your medical costs.
It solves a problem the big guys can't solve themselves because they don't have the tech DNA.
Exactly. And for Clover, the revenue quality is totally different.
It's night and day.
Insurance revenue is low margin, 3% or 4% if you're lucky. SaaS revenue, software revenue, that can be 70% or 80% margin. And it commands a much higher valuation multiple on Wall Street.
Right now, Clover trades like a distressed insurer, 0.5x or 0.6x revenue. If Counterpart takes off, they could trade like a software vendor, 5x, 10x revenue. It's a whole different conversation.
That's the unquantified upside. Right now, the market is barely pricing it in. It's like a free call option. But if they announce a major deal with a national payer in 2026, the stock re-rates overnight. It changes the narrative from health insurer to health tech platform.
Oh, yeah, we have been very positive. I mean, we've laid out a very compelling bull case. We've looked at the growth, the profits, the tech. But this is the deep dive, and we need to be realistic. We need to be skeptical.
Time to pour some cold water on it.
There are dark clouds on the horizon.
Yeah.
Section 6. Critical risks. Because while 2026 looks great, 2027 looks complicated.
Complicated is a gentle word. Let's call it the star ratings cliff.
This is the biggest red flag. Explain the timing disconnect again because it's confusing, but it's crucial.
So star ratings work on a delay. The rating announced in late 2025 determines your payments for 2027. And recently, CMS downgraded Clover's PPO plan to 3.5 stars for the 2027 payment year.
So that $50 million bonus we just celebrated for 2026
Evaporates.
It evaporates on January 1st, 2027.
Poof. Gone. That is a massive revenue headwind to hit you right after your first profitable year. It's like getting a big raise and then immediately getting a pay cut the next year.
Management says they can still be profitable at 3.5 stars. Is that realistic?
Theoretically, yes. If the J-curve keeps working, the medical savings from those maturing cohorts should outweigh the loss of the bonus. But it removes the margin for error. Completely.
So they have to execute perfectly.
They have to execute flawlessly in 2027 because they don't have the government subsidy padding their pockets.
So 2026 is the year to build up the war chest because 2027 is going to be a street fight.
Exactly. And speaking of street fights, we have risk number 2, utilization spikes.
The boogeyman for the whole industry right now.
It's the boogeyman. Post-COVID, seniors are accessing care at record rates. We are seeing spikes in inpatient vascular surgery, cardiac procedures, outpatient oncology. Costs are going up for everyone.
And this brings us back to the new member problem. Clover just onboarded 50,000 new people. It is a race against time, isn't it?
It is a sprint. We call it onboarding velocity. Can you get those 50,000 people to see a doctor and get their data into Clover system before they have a heart attack, before they need that vascular surgery?
If the utilization spike happens faster than the onboarding,
then the J-curve gets deeper. That Netanus $110 loss becomes a Metamesh $150 or Netanus $200 loss. And the path to profitability narrows. If the new members get sick before the AI can help them, the model takes a big hit.
Finally, there is the show me risk, the trust gap.
This is a real one. Clover came public via a SPAC led by Chamath Palihapitiya. That entire era, let's be honest, left a bad taste in investors' mouths.
A lot of overpromising and underdelivering across the board.
And the stock is down 90% from its highs. There's a lot of scar tissue there.
They have cash, though. It's not like they're going broke tomorrow.
No, the balance sheet is strong. Zero debt. About $396 million in cash and investments as of Q3 2025. Insolvency isn't the immediate risk. Irrelevance is the risk. The market is skeptical.
They have to deliver.
They need to print that first profitable quarter. Until the ink is dry on the GAAP net income, the skeptics will just say it's another slide deck.
Trust but verify. Or in this case, verify then trust.
Exactly. They have to prove the physics of the J-curve work at this scale.
So let's bring it all home. The verdict. Clover is executing a high-space pivot. They are taking the customers everyone else is rejecting and betting the house that their AI can fix the economics.
It's a classic contrarian bet. While the industry zigs toward restriction, Clover zags toward openness, powered by data.
Our sources and the consensus we're seeing call it a speculative buy.
I think that's the right term. The upside is asymmetric. If the 2025 cohorts mature and the J-curve holds, 2026 will be a breakout year. The stock is priced for failure trading at half its revenue, so success would be explosive.
But if the utilization spikes overwhelm the AI, or if retention drops even a little bit, that 2027 cliff looks very, very scary.
It's going to be a white-knuckle ride, there's no doubt about it. But for the first time in a long time, the math is on their side.
Here is the final thought for you to chew on. 2026 is the year the physics of the J-curve meets reality. It's not just a spreadsheet anymore. It's 153,000 real human beings. Will the technology hold up under that weight? We are going to find out in the earnings reports over the next 12 months.
It's the most interesting turnaround story in healthcare right now, bar none.
Risk defined, portfolio protected. Thanks for listening to this deep dive into Clover Health. We'll see you in the next one.
Goodbye, everyone.